Okay, let's unpack this. Today, we're diving deep into the world of Dutch tax law. Now, it might sound, dense, maybe a bit dry, but it's actually a surprisingly dynamic system. Some very unique structures, clever ways to manage your finances. Our goal today is really to cut through that complexity, pull out the most important insights from your sources, and give you a real shortcut to being well informed.
Indeed. And the Netherlands really does present a distinctive tax landscape. You've got the box system for classifying income, specific incentives, and some critical international considerations. Understanding these nuances isn't just academic. It can be crucial for your financial strategy, whether you're a resident, an entrepreneur, maybe an expat, or just someone planning for the future. We'll help connect the dots.
Yeah, connect the dots between how it works and, well, why it actually matters to you.
hmm
So today's roadmap, we'll explore these three boxes of income. We'll highlight key deductions, exemptions, things that can really impact your tax bill. We'll definitely delve into the rules for international assignments, that famous 30% ruling, and importantly, its recent changes. And finally, we'll look at how wealth transfer and things like trusts are handled. And just to be clear, all of this is based on the comprehensive material you shared. So let's jump in.
Right. To really get a grip on Dutch tax, we have to start with this unique way it categorizes income, the box system. Think of them like different buckets for different income types, each with its own rules, its own rates. First up is box one. That's your living and working income.
That's right. Box one is where most people encounter the tax system day to day. It covers your income from employment wages, salaries, bonuses, also profits from business activities if you're self-employed. And interestingly, even income related to your primary residence. The tax rates here, they're progressive. So they increase with income, generally ranging from, let's say, roughly 37% up to nearly 50%.
Okay, progressive rates. And for employees, there's that Loonheffing, the wage withholding tax. That's like a prepayment.
Exactly. It's taken directly from your salary. And there's some interesting tax-free benefits, too, under the work-related costs scheme, the work cost and regeling, things like travel reimbursement, maybe work-related tech. Plus, pension contributions are usually tax-exempt when you make them. The tax comes later when you receive the pension payout.
Got it. And homeowners, you said the primary residence is in box one too. How does that work?
Yeah, it's unique. You're sort of deemed to earn a notional rental income from your own home. It's called the Eigenwoning forfeit, even if you obviously don't rent it out. But on the flip side, the mortgage interest on that primary home is deductible for up to 30 years. That's the mortgage interest relief, and it's quite significant for many.
Wow. Okay. So even just owning your home has these tax flows in box one. What about entrepreneurs? Are there specific breaks for them in box one?
Absolutely. If you're self-employed and meet certain conditions like working a minimum number of hours, you can claim the self-employed deduction, the Zelfstandig trick, and possibly a startup deduction, the Starter-Saf for new businesses. After you apply those, there's the SME profit exemption, the MKB winstfree that deducts another 12% of your remaining profit. So effectively, only about 88% of that profit ends up being taxed in box one. It's a substantial reduction.
Okay. So box one is very much about your active income, your job, your business, your main home. But what about investments? That's a big piece for many people. That brings us to box two, right?
Exactly. Box two is specifically for what's called a substantial interest, aanmerkelijk belang. This usually means owning 5% or more of a company's shares, either directly or maybe with a tax partner. It mainly affects, owner-directors of private companies or significant investors.
And the tax rate is different here, not progressive like box one.
Right, it's a flat rate. Well, it was a flat rate, around 27% recently. But here's a key change. Starting in 2024, the box 2 rate is split. There's a lower rate, about 24.5% for profits up to roughly 67,000 euro, and then a much higher rate, 33% for amounts above that threshold. This really changes the game for planning profit distributions, for business owners.
That's a big shift. Okay, so that's box two for substantial shareholdings. Now, box three, this is where I think it gets really intriguing because it doesn't tax your actual investment income. It taxes a sort of pretend income.
Precisely. A deemed or notional return. It's essentially a form of wealth tax, calculated on your net assets in box 3. The tax authority basically assumes you're making a certain annual yield on your savings and investments, regardless of whether you actually made that much or maybe even lost money. And that deemed return is then taxed. The rate is 36% for 2024 and 2025.
36% on an assumed return. That sounds potentially problematic.
Well, it has been very controversial, hugely so. Back in 2021, the Dutch Supreme Court actually ruled the system violated the European Convention on Human Rights, which led to this flat-rate savings alternative for the years 2017 to 2022, basically allowing people to be taxed closer to their actual returns for those years, which was a big deal for fairness. And now, a whole new system based on capital growth is planned, but not until 2028.
Okay, so it's a system in transition. What kind of assets actually fall into box 3?
It's quite broad, really. It covers your cash, bank deposits, stocks, bonds, cryptocurrencies, also real estate that isn't your primary home. So second homes, rental properties, and other investments too, like gold or art if held primarily for investment. You can subtract certain debts, like mortgages, on the second properties, although there are thresholds. But crucially, your main home, that's box 1, and your pension assets, those are generally excluded from box 3.
Right, right. And there's a tax-free allowance, so not everyone with savings pays this tax.
Exactly. That's very important. There's a substantial tax-free capital allowance in box 3. For 2025, it's around 57,000 euros for singles, and double that if you're filing with a tax partner. So yeah, many residents with, let's say, modest savings won't pay any box 3 tax at all.
So you can really see how understanding these 3 boxes is just foundational, isn't it? It's not just about what you earn, but how your income and assets are categorized. Each box has its own rules, its own implications. Okay, so we've got the basic box structure down. But beyond that, the Dutch system has specific allowances, exemptions, ways to potentially lower your tax bill. It's about knowing where to look for those opportunities, right?
Absolutely. And these provisions aren't just, minor tweaks. They often reflect wider policy goals, like encouraging certain investments or supporting people during specific life events. Let's look at a few key ones and maybe start with green investments.
Yeah, you mentioned policy goals. I've heard about incentives for green investments. Is there an exemption in box 3 for those?
Yes, there has been. For certified green investments, you could get an extra exemption in box 3 plus a small tax credit. However, and this is a big change, this incentive is being significantly cut back. For 2025, the exemption is being slashed to around 26,000 euros, and the entire scheme is set to be fully abolished from January 1st, 2027.
Wow, abolished completely. That's critical information for anyone holding those assets.
It really is. It shows how these incentives can change. Those assets will just be treated like any other box 3 investment soon.
Okay, noted. What about gift and inheritance tax allowances? That's often top of mind for families planning ahead.
Very much so. The Dutch inheritance and gift tax laws, they're outlined in the Successie 1956. They do provide some pretty generous exemptions. For annual gifts, for instance, parents can give a child a certain amount tax-free each year. For 2025, it's around 6,700 euros. And for gifts to anyone else, maybe a grandchild, a friend, there's a smaller annual tax-free amount, about 2,700 euro for 2025.
Okay, those are the annual ones. Are there bigger sort of one-off exemptions, maybe for adult children?
Yes. For adult children aged between 18 and 40, parents can make a one-time larger gift. It's over 32,000 euros in 2025, and that can be used for any purpose. Or, if the money is specifically for an expensive study or training course, that one-time exemption is even higher, over 67,000 for 2025, but there are conditions attached.
Right. But wasn't there a really big one for buying a house? The Jubilton.
Yes. The Jubilton. That's another major change you need to be aware of. That specific, very large one-time exemption intended for a house purchase was completely abolished in 2023. That's a huge shift. Many families were using that or planning to use it to help younger generations get onto the property ladder. Now they need a different strategy.
Abolished.
Yeah.
That really changes things for intergenerational wealth transfer related to housing.
It certainly does. On a more general note, gifts between spouses or registered long-term partners are typically exempt from gift tax altogether, often due to community property rules or specific partner exemptions.
Okay, so whether you're planning for your kids' future, thinking about investments, or just trying to understand deductions, knowing these allowances and, crucially, how they're changing is vital for managing your finances effectively and legally. Let's shift now to international mobility. The Netherlands is a big hub for international talent, and the tax system, especially certain incentives, can be a major factor for expats. The 30% ruling, that phrase comes up all the time. What exactly is it, and what are these recent changes everyone's talking about?
Right, the 30% ruling, it's been a very significant tax advantage designed specifically to attract highly skilled foreign employees. Essentially, it allows an employer to pay 30% of the employee's gross salary as a tax-free allowance. This could last for up to 5 years, effectively lowering their taxable income, sometimes quite substantially. Makes the Netherlands more competitive, financially speaking.
Sounds powerful, but it's not for everyone, right? Who qualifies? What are the criteria?
No, definitely not for everyone. There are strict conditions. First, the employee needs specific expertise that's considered scarce in the Dutch labor market. This is usually judged based on meeting quite high minimum salary thresholds. These are indexed annually, often tens of thousands of euros per year, and they vary by age and qualification. Second, they must be recruited from abroad. There's a specific distance requirement residing more than 150 kilometers from the Dutch border for most of the 2 years before starting the job. And third, the employer has to be a registered Dutch wage tax withholding agent.
Okay, quite specific hoops to jump through. And if you do qualify, does it affect your box 2 or box 3 situation as well?
Yes, and this is another major benefit. People with the 30% ruling can opt for partial non-resident status. This generally means they aren't taxed in the Netherlands on their Box 2 income from non-Dutch companies, or on their Box 3 assets held outside the Netherlands, except for Dutch real estate. That's a huge advantage for expats with global assets.
So it impacts more than just the salary, but I keep hearing about changes, big changes. What's happening?
This is crucial, yes. As of January 1st, 2024, the 30% ruling is being scaled back significantly. The full 30% tax-free allowance now only applies for the first 20 months of the 5-year period. Then for the next 20 months, it drops to 20%. And for the final 20 months, it goes down again to just 10%. There is a transitional rule for people who already had the ruling in December 2022. They keep the old system for a bit longer until a cap potentially applies in 2026. But for new arrivals, the benefit is definitely reduced over the 5 years.
Wow, 30, then 20, then 10%. That fundamentally changes the calculation for people considering moving, doesn't it?
It absolutely does. It makes the financial benefit less substantial over the full term. Staying up to date on this is key.
Definitely underscores the need to stay informed.
Okay, moving beyond the 30% rule. What about the basic immigration pathways for longer-term work assignments? Well, for skilled workers coming for longer assignments, the main routes are usually the Highly Skilled Migrant Program, the HSM program, or the Intra-Corporate Transfer ICT Directive, or perhaps the European Blue Card. These generally require a sponsoring employer in the Netherlands who handles the application. And again, eligibility often hinges on meeting significant gross monthly salary requirements, which are adjusted each year.
And can family come too? What about eventually staying permanently?
Yes, these programs, HSM, ICT, EU Blue Card, typically allow dependent family members, so spouses and children under 18, to come along. And those family members usually get free access to the Dutch labor market, which is a big plus. As for staying, after 5 years of continuous legal residence and passing the civic integration exams, applying for permanent residence is usually possible.
So for anyone thinking about an international career move or relocating to the Netherlands, understanding these tax rules like the changing 30% ruling and the immigration pathways is just absolutely vital. The landscape is definitely shifting. And speaking of the long term, let's talk about protecting and transferring wealth. This often involves careful planning, sometimes across generations. How does the Dutch system handle things like inheritance and maybe entities like trusts?
Right, this is where tax law really meets civil law. There are provisions aimed at helping generational transfers, especially for businesses, but also rules designed to prevent tax avoidance, what the authorities sometimes call floating wealth assets escaping tax altogether. Inheritance tax, for instance, is levied on the worldwide property of someone considered resident in the Netherlands when they die. And here's a detail that often catches people out. Dutch citizens are deemed resident for 10 years after they emigrate, specifically for inheritance tax.
10 years. So even if you move abroad, your estate could face Dutch inheritance tax for a decade. That's significant.
It is. It requires careful planning if you're a Dutch citizen moving away permanently.
What if it's the other way around? A Dutch resident inherits from, say, a relative abroad who had no Dutch ties.
In that case, the Dutch resident heir usually doesn't owe Dutch inheritance tax on that specific inheritance, though the foreign country might have its own taxes.
Yeah.
However, once that inheritance is received, the money or assets become part of the heir's Box 3 capital. And from that point on, it's subject to the annual Box 3 wealth tax, assuming it exceeds the allowances.
Okay, so it becomes part of your taxable wealth base going forward. What about charitable giving? How's that treated?
Gifts and inheritances to recognized Dutch charities, these are called ANBI's, Algemeen Nut Bujend Instelling, are completely exempt from gift and inheritance tax. And there's an extra perk for personal income tax, too.
Yeah.
If you donate to a cultural ANBI, you can get a 25% multiplier on your deduction up to a certain limit. So a bit of an extra incentive for supporting culture.
That's a nice touch. Now, for business owners looking to pass their companies on, you mentioned facilities for that.
Yes, the business succession facilities, known as the BOR, Bedrijfsopvolgingsfacility. This is really important, especially for family businesses. It provides a very large exemption, currently 83% for business assets, including shares in an active company if you have a substantial interest. And even better, the first chunk of value, currently around 1.3 million of those business assets, is fully exempt from inheritance or gift tax. It's designed to prevent businesses from having to be sold off just to pay the tax bill upon succession. Though it's worth noting there's ongoing political discussion, and these facilities are widely expected to become less generous in the coming years.
Another area to watch closely then. Okay, let's touch on trusts and foundations. The Netherlands doesn't have its own trust law, I gather, but it recognizes foreign ones. How does that play out tax-wise?
That's correct. The Netherlands signed the Hague Trust Convention, so it recognizes legally valid foreign trusts. But for Dutch tax purposes, things like family trusts are often classified as separated private assets APVs or SPEs. Under this regime, putting assets into such a trust is often sort of ignored for brush income tax and gift inheritance tax purposes at the time of transfer. The assets and liabilities are generally still allocated back to the donor, the settlor, to prevent this floating wealth situation. And distributions from the trust down the line are frequently treated as gifts from the settlor to the beneficiary.
Interesting. So it doesn't necessarily shield assets from Dutch tax in the way people might assume. What about a stack? I hear that term sometimes.
The Staatsstichting Administratie. That's a specific Dutch foundation structure. It's often used for asset protection, particularly for company shares. It separates legal ownership, held by the stack, from beneficial ownership, held by certificate holders. For tax purposes, a stack is usually considered transparent, meaning the tax isn't levied on the stack itself, but on the certificate holders, the ultimate beneficiaries.
Okay, transparency seems to be a theme here. How is global transparency affecting trusts and these kinds of structures now?
Is having a huge impact. Since late 2021, the Netherlands has implemented a public UBO register that's ultimate beneficial owner, specifically for trusts and similar legal arrangements. This means information about who set up the trust, the trustees, key beneficiaries, protectors, that's now publicly accessible with some privacy safeguards. It's part of a much broader international trend towards transparency, driven by initiatives like FT with the US, the Common Reporting Standards, CRS globally, and EU directives on mandatory disclosure of cross-border arrangements. The days of easily hiding assets offshore are largely gone. Information exchange between countries is becoming increasingly automated and widespread.
So whether you're planning your estate, thinking about charity, or dealing with international wealth, understanding these evolving rules, especially around transparency, is just paramount. Cross-border planning really needs careful thought and expert advice now. Well, we've certainly covered a lot of ground today. We journeyed through the intricate world of Dutch tax, from those three distinct boxes for income and wealth to strategic allowances like for entrepreneurs, and that ever-changing 30% ruling for expats. It's clear this is a system with many layers, and it's definitely not static.
Absolutely. And we also touched on that complex area of wealth transfer gift tax, inheritance tax, the special rules for business succession, and the Dutch perspective on trusts.
Yeah.
All of this happening within, as you said, an increasingly transparent global financial landscape. These systems are dynamic, they evolve. And sometimes, like we saw with Box 3, they face significant legal challenges that can even lead to retrospective changes.
So what does this all really mean for you listening in? As you manage your own finances, maybe think about how these dynamic tax frameworks, both the Dutch ones and the international pressures, how they might influence not just your situation right now, but your future planning too. And maybe this raises a final broader question for you to ponder. In a world where tax laws are constantly being updated, reflecting societal values, economic needs, global transparency demands, how can individuals and families best adapt their financial strategies? How can you navigate these changes effectively and, responsibly